Hey y'all, my name is Casey Jackson, Registered Commodity Trading Advisor with the National Futures Association. I have been in this trading space for the last 7 years as of last month. I started learning how to trade in September of 2017, and it has been a journey. I started out with a company like many of you all, and it took me several books, several courses, and several experiences in order to end up at a place where I could, on my own, find setups like this, or like this one, or like this. So my goal and my hope today is that this information is as transformative for you as it is for me. What you can look forward to learning is understanding what market structure is. How do you understand market structure in order to find better entries, better exits, and overall become more profitable? So no matter if you're a scalper, if you're an intraday trader, or you're a swing trader, this video is for you. So get somewhere quiet, get your notebook, and let's get down to work. Okay, so once we get through this information in this course, you will understand better what market structure is and how you can move throughout it in order to make your trades work for you. You'll understand how to combine market structure with Fibonacci and how to make projections based off of what you're seeing with that Fib tool. You'll have an introduction into Elliott wave theory concept. It was something that was extremely helpful for me in my growth as far as a trader, and it kind of shed light and gave me the aha moment that I was looking for, and I'm hoping that it'll do the same for you. And then you'll have an introduction into technical analysis, and truthfully, I think you're going to get a lot from this as far as helping to strengthen your technical analysis approach. But before we get into the nuts and bolts of everything, I want you to grab a pen and a paper. I want you to be focused, right? Turn off all the distractions. We don't need text messages going off. We don't need a phone's ringing. I need you to be focused. So get somewhere that you can get quiet, you can get settled, you can get focused, and then take notes on this information that you're about to get. And be sure to know you can always come back to this video as a resource. It will be here for you to come back and get what you may have missed or just to study again. So before we get into the details of market structure, let's understand why it's important for you as a trader. What it will do for you, it would allow you to be able to recognize where in the market you are, right? So you don't want to be trading sells when the market is moving overall in a buy, right? Or in an uptrend. You don't want to be trading a reversal to the downside when the market is moving in an uptrend. What understanding market structure will do, it will help you increase the probability of being able to accurately enter and execute a trade and when to know when to get out of it. It's also going to increase your ability to be profitable in the market. So let's start at the very basics. Let's talk about what a trend is. A trend is the overall direction that price is moving in a given time frame. So a market trend can be bullish, it can be bearish, or it can be moving sideways, which is also known as consolidation. Bullish term means that price is moving in an uptrend. So the trend can be different depending on the time frame of the chart that you're looking at. So if you're on the monthly and price is moving in a clear uptrend, it is no surprise if you get down to a 4-hour and price is moving in a downtrend. And so we'll talk about that more as we move throughout the trading. I'm going to be saying some words and I want you guys to be on the same page as me. And price action is one of them, right? So price action is just the movement of a pair over a period of time. And you see I got the arrow at the bottom, and you'll see that the price action of this pair, price is moving to the upside. So that's what I mean when I say that. Examples on real live charts, so you'll be able to see. So I'm looking at this chart from CAD JPY. We're just identifying uptrends and downtrends. So when I talked about the uptrend in the market, this is considered a bullish uptrend because the overall direction over the period of time from the low here, over the period of time, which direction has price moved? Type it in the comments below. Which direction has price moved from this low if we look and continue to read from left to right? Price has moved in an uptrend, and it's called a bullish trend. A bearish trend means that price is moving to the downside. Now, this is considered the bearish downtrend, right? So you see there is clear direction, and I'm trying to remember, I think this is Euro CHF. I can't see at the top, but you'll see we're on the monthly chart, and over the course of time, starting from the highest point, right? We read left to right, how we read a book, left to right. Over time, we can see that price has dropped. And so this is clearly a downtrend, what we call in the Forex industry, a bearish trend, a bearish market. So in this market, on this time frame, you would be looking for potential sales. And consolidation means that price really isn't moving much of anywhere between a high and a low over a period of time. Now, this is a monthly chart. I believe this is Euro CAD. And yes, you'll see some down. Yes, you'll see some up. You see some down. But overall, price has not moved much between these two levels. So in a higher time frame, price is moving sideways. There's no clear trend or clear direction to an upside or a downside. Now, if we were to go to the lower time frames, we'd be able to see a little bit clearer that there are clearly some moves in the market that you can trade. I told you at the beginning I was going to bring in Elliott wave theory a bit into this because this is where things really begin to make sense for me. And there's a book by Robert Prechter called The Elliott Wave Theory. And it seems a little boring at first, but if you get into the nitty gritty of the book, it's going to give you some information that I promise you will give you that aha moment that you're looking for in your trading. And so I'm going to only lightly scratch the surface. We are not going in depth with Elliott wave theory. I likely will do an advanced market structure video where I explain a little bit more, but having just the basics and the knowledge of understanding how price moves in the market is going to help you. And so we know that price does not move straight up. It does not move straight down. The market moves in waves. And so you'll see on the screen that over in orange, I have something called a motive wave. And that is an impulse wave. So a motive wave can move to the upside on an uptrend, and it can move to the downside in a downtrend. And you'll see in green, I have the corrective wave. We also know it as a retracement. And so what I want you to take from this is that this entire sequence is considered one way, right? So let's go to the next slide. I'll break it down even further for you. So a motive wave, it will always subdivide or have 5 parts to it, right? And there are some rules that go along with that. But again, I'm going to keep this basic for you. You have waves 1, 3, and 5 that are going to be your impulse waves in an uptrend. Waves 2 and 4 in that uptrend are going to be your retracements, right? So you will have an idea of where you can execute. So if you're looking at a trade and you see that waves 1 and wave 2 have already happened, and you're looking for an entry to get in to ride waves 3 and waves 5, you know that your entry is going to be at the bottom of wave 2. And we'll talk a little bit more about Fibonacci as we move through this. But this is where your fibs come into play. You figure out how to get in and how to ride the move all the way to the end of the projection. So again, the motive wave it always has 5 parts. The 1, 3, and 5 are going to be your impulse moves. And you'll notice too, if you look at the chart, you'll see that price moves really fast or faster than it does on waves 2 and 4. In waves 1 and 3, you'll see a smaller version of this entire sequence, right? 1, 3, and 5. That's what I meant to say. You'll see a smaller version of this, what we call fractals. Okay, really quickly, to try to break down fractals so you understand what I'm talking about. A fractal is just a smaller version of what's playing out on the higher time frame. So on the higher time frame, we would know if we're in an uptrend that eventually this 5-wave sequence is going to play out. On the lower time frame, what you're looking for is a smaller version of that. That's what's going to happen. So highlighted in gold, you see wave 1. Wave 1 on the lower time frame, so let's call it not the hour, it might be like the 30-minute, you'll see this play out, right? You'll see a smaller version of this play out. So in a corrective wave, it's a 3-wave pattern, right? It moves opposite of whatever that dominant trend is on a higher degree. And it's easy. You may hear people say A, B, C. And we also use fibs to determine how far a retracement could potentially go. Waves 1 and waves 3 are going to look like those impulses going down. Wave 2 is going to look like that corrective structure. So we'll dig deep a little bit more into that on this next slide. So earlier in the video, I broke down that each of these legs is a small version on the lower time frame of their move. So like this is an impulse, the smaller time frame. So let's say this is on the 4-hour. On the smaller time frame, this is what I'm expecting to see. So for example, when I say I find a setup on the 4-hour, I'm not waiting until price retraces on the 4-hour at this level that I'm highlighting right here. What I'm going to do is I'm going to go down to the lower time frame. Let's call it the 15-minute. And I'm looking for this first leg to be completed, this second leg to be completed. And then I know I can take my entry right here where I'm highlighting and ride it all the way for the rest of, let's call it 200 pips for the rest of the move. So when I say I find the setup on the higher time frame, but I find my entry on the lower time frame, I take my entry off the fractal. I hope that makes sense to you. So in the impulse, you have the five subdivision of the wave, right? So it'll be this. On the retracement, you're going to have this move, right? So I'm trying to think of the best way to explain this, that on every higher time frame move, you have a smaller move that is just like it on the lower time frame. I hope that makes sense to you. So every impulse, wave 1, wave 2, or wave 1, wave 3, wave 5 are all going to have this move right here, this impulse move. Wave 2 and wave 4 is going to have this move, right? So even on the retracement, the impulse of the retracement is going to be subdivided into 5 ways. The retracement is going to be subdivided into 3. If it's a certain type, it's called zigzag. That's the most common that we see. I won't get into the details of the other in this video, but you can check out the next video and I will. But that last, that this is A, right? This leg is A, this is B. So that B move is going to be a retracement, a corrective structure. And then this C move is going to be an impulse, the subdivision of the 5 waves. So I hope that makes some sort of sense to you. If you want to go ahead, sign up to my email list. I will be sure to send you a breakdown of a little bit further explaining Elliott Wave just a little bit more so that you can understand it a bit better. So now that we have an understanding of market structure, we have an understanding of how waves are formed and the anatomy of the wave, that gets us to understanding the entire idea of what market structure is. And so I've taken that same sequence, right? So we had the motive wave in orange, and then we had the corrective wave in green. And then the sequence just starts over again. So in this example, what I'm trying to illustrate to you is that you can get an idea of a change of structure a couple different ways. So in here, we see that in this example, this level of red was a point of resistance at one point. Price broke through, right? Surpassed it, and then came back and retested that level that was once resistance, and now it found a level of support. How we identify support and resistance is simply swing lows and swing highs, right? And we'll go more into detail on that on the next slide. But resistance, you can think of it as like a ceiling, right? So you may see on a chart where an area where price has tried to break through and could not break through. You'll see wicks, you'll see rejection off of a certain area or zone in the market. That is considered to be resistance, a ceiling. And it's a level in the market where sellers are entering in at a higher rate than buyers, right? And remember, I talked about that 5-candle formation forming a swing high, which makes that level of resistance. Level of support, same thing, right? Except you've got a swing low instead of a swing high, but you can think of it as a floor in the market. It's a level where buyers are entering the market at a higher rate than your sellers. And so that 5-candle formation, you would find somewhere over here, and it would be considered your level of support. And you have to have the 5 candles in order for that support or that resistance level to be valid. So let's talk about what the swing high and what the swing low is. And so a swing high, as I mentioned, it's a 5-candle formation where the outside 2 candles to the right and the left are lower than the center candle. So to me, it almost reminds me of like an arrow. It forms the structure of resistance. And now I get asked a lot, like, does that mean you include the wicks or do you only include the body? You include the wicks as well. So wherever price starts, that's where you measure. The swing low is just the inverse. Swing low is a 5-candle formation where the outside 2 candles to the right and left, so right here and right here, are higher than that center candle, and that center candle is lower. So it's like a reverse arrow, right? It forms your structure level of support. And again, in this instance, it is measured from the start of price. Your wicks will be included. Now that we understand how waves move in the market, right? We understand that price does not move just straight up or straight down. We understand how support and resistance levels are formed. Let's take a look at trend lines. Now, these used to give me the blues when I first started learning how to trade. I really didn't understand how to draw them. I really didn't know what I was supposed to be looking for with the trend line, but I'm going to show you exactly how you can use trend lines in the market to help you better understand the overall trend of the market, while at the same time using this as a tool to identify break of structure or change in direction. And trend lines help tell you the overall speed, direction, and momentum of the market. And so we'll go into how you're supposed to draw them. But again, that's what used to give me the flux. I didn't understand how I was supposed to be drawing trend lines. Now, it's funny, in my my community the other day, someone sent me a screenshot of this as they were going through my course. And they're like, I see a buy. Why would I be drawing a trend line like this? So in an anticipated sale, so this is used in conjunction with other pieces as far as your analysis. You do not just draw a trend line to the upside and think that you're going to see a sale. You're also looking at the overall higher time frame. You're looking at where your key levels are, so your higher time frame levels, right, in order to determine this. But at a base level, how you draw a trend line for an anticipated sale is you connect swing low to swing low. The main thing to remember is you never want to cut through a candle, meaning you don't want to draw the trend line where it's not connecting with each swing low. And so you'll see on the screen diagram that the trend line starts at the low, right? And then you connect it to the next swing low. So I like to use the ray tool in order to be able to do this, because that way I can't cut through candles unless I'm like truthfully dragging the entire line down to break through candles. So I think of it as like a tabletop, like you're sitting the top of a table onto the legs. That's the best way I can describe it. And so you connect from swing low to swing low. And your orange is the trend line. So to look for sales on an anticipated buy, it's just the inverse, right? We're connecting from swing high to swing high. And what we're looking for in that break of structure, we'll go back to what we're looking for in an anticipated buy. We're looking for a break of structure. So structure is that price has been approaching this trend line, it drops off. It formed a high, right? It retraced, price approached this level again, then we dropped off, right? And so now price approached this level and it's broken through the trend line. This is a signal that market structure could potentially be changing from what it was before, right? It is a signal that price is changing from a downtrend and could be changing into an uptrend. So in a anticipated sale, this is what we're looking for. Of course, yes, price is in an uptrend. We see buys all day. But what we're looking to see, we want to be able to catch where price is reversing and when we want to ride those moves out, right? So you'll see on this one, swing low to swing low connected. Orange is our trend line. And you'll see when price came to this level, this trend line, it respected it. We had a buy opportunity. Price came to this trend line, respected it. We had another buy opportunity. We would think that price would come to this level, respect it, another buy opportunity. But this here, we experienced a change in structure. Price broke through this trend line, and now this is signal for me that the market structure is changing from an uptrend into a downtrend. Fibonacci is a tool that changed the trading game for me. I know a lot of people say it's kind of prophetic, that it tells you where to get in, where to get out of the market, and it does. Now, do you use this by itself in order to be able to determine a trade? No. You can use it in an overall higher time frame analysis to shed more light and basically like add ammunition to your argument as to why a trade should take place. Now, I know you might see a bunch of lines on the screen and you're trying to figure out what's going on. I'm going to break it down for you. Don't worry. You'll see that bracketed off are levels in different colors. You have the 23.6, the 38.2, the 50, the 61.8, 78.6, 86, and 100%. Those are your retracement levels. I like to call them the entry levels. Then you have a section above that says extension levels, and you got 0%, negative 0.18%, negative 0.27%, and negative 618%. These are your take profit levels. So theoretically, and why I have them color coded is because if price retraces to a red level, theoretically, you can ride the trade to the red level. If price retraces to a blue level, 78.6, theoretically, you can ride it to the negative 0.27. If price retraces to the 8.6, theoretically, you can ride it to the negative 0.18. And then if price retraces 100%, you can anticipate that it's going back to 0%. Now, again, you can't use this by itself. You absolutely have to combine it with some other factors in order to be able to determine exactly what you should be doing. But that is the way it works. Now I'm going to show you how you fit this onto the wave sequence that we just learned about at the beginning of the video. All right, y'all. So I told you that I would show you exactly how I use Fib on the charts. So I've got the monthly chart of AUD USD pulled up, and I actually probably need to go to a lower time frame. I'm going to go to the daily because you'll be able to see the Fib in action, right? So I'm going to grab my Fibonacci tool. It's already configured. And the way that you run Fibs are going to be from swing low to swing high, and then swing high to swing low on a downtrend. So on an uptrend, swing low, low to high, and then on a downtrend from high to low. All right. So I'm going to take this on an uptrend. If it wants to work right today, I'm going to take it from the low, click to establish my low, and I'm eyeballing to make sure that I am choosing the right makeup. So I'm going to double check this because I want to make sure, y'all, that I'm showing y'all the right thing. And it looks like I did. So I'm going to delete that. And you'll see that I drew from this area here at the bottom to this swing high here. And I eyeballed it, right? And so in this scenario, we had price pull back to, we can call it a red level, right? Even though it did not touch it, it is still considered to be at the 23.6 or less than 23.6. So theoretically, it should run to the red level, which is exactly what we have here. Price took profit right there. How you measure the next fib is from the swing low to the next high that formed. And I'm looking, and I believe we have a high. I'm going to delete this, and I'm going to draw again. Our low, I believe, was here. Our next high is here. And so we have a swing low to swing high. And actually, I think that's going to be right there. And then we have a red level pullback. So we look at where the wick actually touched. The wick it didn't touch the 786, it touched the 618. And so theoretically, our take profit is here at 69876. 867. I said that backwards. You got it? So again, how do we draw fibs? We draw on a buy. When we're looking for opportunities to get in on a buy, we're drawing from swing low to swing high. The areas within the black lines are going to be your areas for entry. The areas to take profit sit outside the black line and are red, blue, green. That tells you where to take profit. All right. That's the fib. If you want a deeper explanation, I definitely encourage you to check out the no cost mini course. I break down a lot about Forex, and I go over structure. I go over how I use the Fibonacci tool to get great entries and on-time exits in detail. It doesn't cost you anything. Just click the link in the video description to check it out. All right. Now, there is something else that I want to show you too, as far as, remember how we drew the support and resistance? I want to show you on the chart how I talked about past resistance becoming future support. And so you see that I've eyeballed, and I'm going to tighten this up because that's too thick. I'm going to tighten it up. Bring it down just a little. All right. So I talked about past resistance, which is here, becoming future support, which is what we have here. This is on a 4-hour chart. And if you're wanting to know how I do the multiple time frame analysis step by step, you can go to any video on the weekly Forex analysis playlist on my channel, and you can see exactly how I mark up the charts. But this example is just to show you market structure in effect, right? So past resistance becoming future support. We had a buy opportunity here. And right now it looks like price is trying to form. I haven't done an analysis, a recent analysis on this pair, so I can't tell you exactly what's happening, but it looks like it might be trying to form a low to continue to the upside, right? So this is past resistance, future support. And so that creates structure. What I also see on this chart, and I'm going to take my ray, as I showed you guys before, let me move this out the way. As I told you, I take the ray to draw my trend lines. So had all of this not occurred, right? And I used my fib and I figured out on a higher time frame that we had hit a key level, and I wanted to take advantage of what the market had to potentially offer on a reversal. What I would have been looking for, let me bring this down. And remember I said how we draw trend lines looking for anticipated sales. They're from swing low to swing low. So I've got my ray. And you see what I mean when I say, like, I can't draw, like, I can't mess up this line, right? And if I know the rules of drawing a trend line to the upside in hopes to find a sale, I know that I cannot cut through candles. So I can't draw the line like this, right? I can't draw it like that. I set it right on top of the next swing low that it touches. You see that? And so what I would have been looking for is price to break, come back up, which it did, and retest the back of that trend line. Let me draw out the circle. Retest the back of this trend line. And I would have known that this would have been my point for entry for sale. Remember, we talked about getting a break of structure off of the trend line. So in the past, you'll see, this is just like the illustration, guys, that I drew. In the past, when price has approached the trend line, let me copy this. When price has approached the trend line, it respected it and price moved to the upside, right? Did I copy it? Oh, come in. I'm sorry, y'all. Having some technical difficulty. Bear with me. This thing don't want to work today. Oh, here we go. Okay. So in the past, when prices come and approached this trend line, it respected it and it bounced, right? Even on the bottom, you had price approach the trend line and bounce up. Then we got over here to this area. Price broke through that trend line. And to me, that would have signaled we have a potential break of structure. The confirmation of the break of structure was the backside retest of that trend line. And your entry for the potential sale would have been the test of that backside. You see? This would have been an awesome entry for a sale. Now, even I'm going to put I have a smart fib on here. So I want you guys to learn how to use it manually. I've already learned how to use it manually. So I have done the hard work and I still do it manually sometimes. But for the sake of time, because I know it's valuable for you guys, I'm going to show you. Now, I eyeballed this, right? And I said this was the point of entry. Now we drew the fib on, and when you're looking for an entry for a sale, you drop fib from swing high to swing low. And so remember, we talked about the fib retracement levels. Price hit the 618. Now, do you include the wicks? Yes. The wick is what you're looking at. Price hit the 618. It didn't come to the 786. It didn't touch it. It passed the 618, but it's still in the 618 zone. So when price pulled back to this level and you saw more sellers coming into the market, this was the cue that you could take the trade down to the 618D extension, right? You see this? Like, it's literally, I don't want to say it's magic, but it's literally magic. So if price pulled back to the red level, you anticipate take profit to the red level. And you're doing this all before price happens. Now, on this 4-hour setup, this was an opportunity for, I'm going to measure from the 618, 108 pips to the downside. So not even completing a full analysis, I can understand that what price is probably about to do. It looks like it's forming a low. Obviously, I am taking a very educated guess. But once price hits the D extension, we see it go back and retrace to find another level and test another level of resistance. And then that is the opportunity for an entrance to a sale, right? And I'm eyeballing this. I'm looking at market structure in order to determine where that next entry point could be. And I'm going to move this down. And what I'm looking at is I am looking at about right here. And what I'm going to do is I'm going to measure with my manual fib tool to see If we do get that low at the area that I'm looking at, what level that is, and look at that zone that I drew is what we call the sweet spot. It's the 618 level. And so if price approaches that level and respects it, I would anticipate another potential sell opportunity down to 67052. Now, this is a very short version of an analysis, but what I'm showing you is the power of being able to use Fibonacci with a little bit of Elliott wave theory, with some market structure, in order to be able to identify where to safely get into the market and the smartest way to get out with maximizing your potential for the move. If this made sense to you, tell me in the comments below. If it didn't, tell me that in the comments below. I want to know what you guys are thinking and how I could potentially explain this more simply for you to be able to understand. And again, if you're looking for a full breakdown of how I mark up charts, go to the playlist on my main channel, check out weekly Forex analysis. And then if you're like, Casey, I really like what you're doing, it looks simple, I want to be able to know how to do that too, then check out the no cost mini course so you can get all of the information that I have to share with you. Okay. So we'll see. I have not, like I said, I have not done a complete analysis on this. I'm simply looking at structure. I'm using my fibs and I am identifying potential opportunities of where price can go on this pair. I might just take a look at USD so I can see, because it looks like it might be setting up for a good move to the downside. All right. I appreciate you guys. I hope this was helpful to you. Please tell me if it was. I've got a Facebook group. I'm on a little bit of a hiatus, but if you like what you're seeing, you want to be a part of a community of people who are like-minded individuals, no hype, no fluff, just want to get the information about trading, click the link in the description that says join my no cost Forex Facebook group. I'll be back up and running, I would say, by November. I'm just working on my schedule to give y'all the time that you all deserve, and it'll be beneficial to you, I guarantee it. Okay, so I appreciate you for watching. I will see you on the next video, and I hope this training was helpful. And if you haven't already checked out the first couple of mini courses that I've done, you might want to too. All right, I'm leaving.